What's going on, guys? My name is Grant Warfield and I'm an accountant. Today we're going to cover accounts receivable. Let's get into it. The topic of this video is accounts receivable. And in order to understand accounts receivable, you must first understand that revenue can be recognized before cash is collected. And this basis of accounting is called accrual accounting. Okay? And if you want to go deeper into the concept of accrual accounting, you could watch my video on the topic. So let me show you how this works in a nutshell. So a company is going to deliver a product or service, and the customer promises to pay later, okay? And because this company has satisfied their end of the bargain, right? They've satisfied their performance obligation. They can recognize revenue under accrual accounting, okay? But as I stated, the customer has promised to pay us later, so no cash is being received here. So revenue is going to be recognized today, cash will be received later. So allow me to briefly walk you through the journal entry here. So we're going to debit accounts receivable because that's how you increase an asset account. You debit that account, and we're going to credit revenue, okay? That's going to be the initial entry for this accounting event. And so accounts receivable is going to represent a legal claim to future cash from customers. That's the technical definition, you could say. And on the balance sheet, we're going to record accounts receivable as an asset. And if you don't know what an asset is, it's simply a probable future economic benefit. If a business expects to receive a future economic benefit from it, they would call it an asset, okay? So since we expect to be paid in the future, accounts receivable is going to be considered an asset. So I've shown you the initial entry here, right? We're going to debit accounts receivable and credit revenue. And so when cash is collected, we're going to have to make another entry, and it's going to go as follows. We're going to debit cash, thereby increasing that account balance, and we're going to credit accounts receivable, thereby reducing that account balance. And it's really that simple. So once the customer pays us, the receivable is going to disappear and it's going to turn into cash. So just to walk you through this basic flow, we are going to deliver a service. Because we satisfied our performance obligation, we have earned revenue, therefore we could recognize it. We're going to record an accounts receivable, and then we're going to collect cash once the customer pays us. Alrighty, guys, I hope this was helpful. Thank you for your time. Like, subscribe, stay tuned. Thanks.